Okay, if you want passive income on a weekly basis, this video will teach you exactly how to do so with options. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you discover this is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And for years, we've been contacted by traders from all over the world who are seeking ways to produce weekly cash income through their trading accounts. And the good news is that options trading provides a perfect way to produce weekly cash income because all index options and a very large number of stock options have options chains that expire every week on Friday afternoons at 4 p.m. Eastern. And it's incredibly easy to start producing cash income if you just learn the 3 simple steps that we'll teach you in this video. If you're new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for understanding the strategy we'll be teaching you in the video. Then when you're finished, you can come back and watch the rest of the video. Let's go ahead and jump into this simple technique for producing weekly cash income from your trading account, which in this example, we'll assume is a $10,000 account. So let's look at an example starting at the beginning of this year, 2023, and you'll see how it works. And so, as you can see, on the last Friday of 2022, December 30th, the S&P 500 index, which trades under the symbol SPX, closed at 3839.50. And so in the first step, we establish whether we are bullish or bearish for the upcoming week using an indicator that we've become comfortable with. So just by way of an example, and I encourage you to use the indicator that you are comfortable with. Let's say a trader likes to use the 10-day simple moving average as his indicator of bullishness or bearishness. And so on December 30th, he would have noticed that the SPX index had closed slightly above its 10-day simple moving average. And so suppose that his protocol was such that if the index was trading above its 10-day simple moving average, he would form the view that the market was likely to close higher next Friday, and thus he was bullish for the week, and therefore his weekly trade has been green-lighted by whatever indicator he's using. Okay, so that brings us to step 2, which is to pull up an options chain that expires a week later, which in this case was the options chain expiring on Friday, January 6th. And once he has done that, then he is ready for the third and final step, which is to go ahead and sell a put option using a lot size which is appropriate for his account, which in this example will be a 10 lot. And you go ahead and sell those puts at a strike price, which is the first put strike price below where the index is closing, which in this case is the 3835 put, 4.5 points below where the index closed. And then simultaneously you buy the same number of puts at a strike price located 5 points below that, which in this case is the 3830 put, both expiring 1 week later on January 6th. And so when he does this, selling a put option right below the current price of the index and buying a put option 5 points below that, when an options trader does that, he is said to be selling a 5-wide at the money put credit spread. Okay, so let's break down what's happened here. And the first thing we want to do is look at the cash flow of this trade. And so when we sold those 10 puts at 38.35, we received the price of 38.10. But remember, each put option on an index pays off $100 per point, so we multiply that by 100, and we sold 10 of them. And so that would result in cash inflow of $38,100 from those puts. But then we turn right around and buy 10 of the 3830s, for which, as you can see from the calculation using that same math, costs us $35,900, resulting in a net cash inflow from selling that put credit spread of $2,200. And that amount, that $2,200, gets immediately deposited into your account on the day that you enter the trade. And you'll see that your account's cash balance goes up as a result by that amount. Now, your broker is going to require you to have at least $2,800 in your account for this trade. But remember, we started with a $10,000 account, so that's not going to be a problem. Okay, so now let's move ahead 7 days to the end of the day on January 6th, the day that these options expired. As you can see, the index closed at 3895.08, which is more than 55 points above the close from the previous Friday, which was 3839.50, as you'll recall. And so because our options trade is expired, the options that it is comprised of can be fully valued. And as you can see, that's a pretty straightforward process, because starting with the $2,200 we first received when we opened the trade initially, we then moved to those short 38.35 puts, which are located more than 60 points below the closing price of SPX. And since puts only pay out if the index closes below the put's strike price, those 38.35 puts that we sold, those just expire worthless. And similarly, the 38.30s that we bought, they also expire worthless for the same reason. And that is because they're way below the index's closing price. And so both options expire worthless, meaning that we just pocket that $2,200 that we first received when we entered the trade in the first place. And so our first week was successful. So at this point, we simply repeat the process every Friday. And so, for example, that same day on Friday, January 6th, with the index closing at 3895.05, you can see that the SPX was trading well above its moving average. And so again, the trade is green lighted. And so we go through the exact same second step, which is to pull up that options chain expiring on the next Friday, January 13th. And again, sell, in this example, a 10-lot put credit spread right below where the index closed, selling the 38.95 puts for 50.80 and buying the 38.90s for 48.45, which, as you can see, results this time in cash inflow of $2,350. Okay, so now let's again move ahead 7 days to the end of the day on January 13th, the day that these options expired. And as you can see, the index closed at 3,999.09, which is more than 100 points above the close from the previous Friday. And so again, starting with the 23.50 we received at the outset of the trade, we simply acknowledge that both the 38.95 and the 38.90 puts expired worthless. And we again just pocket the premium, resulting in a second winning trade in our campaign. And so here's the scorecard so far with the two wins on January 6th and January 13th. Now, moving on to the next week, you can see that we go through our steps yet again, first establishing if we're bullish, which we are again, given that the moving average is located well below the closing price on January 13th. And so we pull up an options chain expiring on January 20th, and this time we sell the 39.95 for 27,850, while simultaneously buying the 39.90s for 25,750, resulting in $2,100 of positive cash flow. But in this case, if we move forward 7 days, we see that the index in this case sold off, and our bullishness was therefore wrong. And so what happens in these cases is, to calculate the outcome of the trade, you again take into consideration the initial $2,100 that you received entering the trade. But in this case, the index closed below both the short puts at 39.95 and the long puts at 39.90. And so to calculate how these puts will settle, we need to calculate how much each of the options is what they call in the money. And you do that by subtracting the closing price of the index from the strike price of the put. And as you can see in the case of the short puts at 39.95, with the index closing at 39.7261, those therefore closed 22.39 in the money. And since they pay off $100 per point and we sold 10 of them, then the result is a payout of $22,390. But on the other hand, the long puts closed 1739 points in the money. And so those created cash inflow to us of 17,390, resulting, when you crunch all the numbers together, in a loss of $2,900. And so now, returning to our scorecard, you can see that we've had 2 wins and 1 loss with a cumulative gain of $1,550 so far. And so looking at the performance of this through the end of last month, August, even without the use of an indicator, because we can't know which indicator you might choose to use. In other words, just looking at the raw results of this campaign, putting a put credit spread on every week, you can see that it won far more often than it lost, and that the final profit of the entire 8-month period was $87.70 on a $10,000 account, which would constitute an 87.7% return in 8 months, nearly doubling your account size. And with a decent, accurate indicator, the number should be even better. And so what I'd like you to take away from today's video is that option strategies are a great way to produce weekly income, because in almost all cases, they can be executed consistently throughout the year, every week, week after week. And so if you have an edge, such as a preferred indicator, you can exploit that edge 52 times a year. And because the index options settle in cash, that edge will very frequently result in immediate cash inflow into your account. Professional options traders take advantage of the cash flow opportunities offered by index options all the time, and there's no reason that retail traders like yourself can't get those same benefits.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.